Hello everyone. Now we are going to start a new topic of CFA Level 1 Alternative Investments. Give the heading Natural Resources. Okay, very easy topic, interesting as well. So you will enjoy it and we'll try to ensure that we will use the practical examples so that you will be able to correlate with all the concepts easily. Give the heading Natural Resources. Natural Resources. Now, the first LOS, your LOS-A, it is about explain the features of raw land, timberland, farmland, and we will understand their investments characteristics. See, the purpose of the discussion is not to do the geography. The purpose of the discussion is to understand the investment opportunities. Clear? Alternative investment will also give you a chance to invest in lands, farmlands, timberlands, raw lands, buildings, and so more. Clear? So now we are going to understand about the features and the investment opportunities, more specifically investment characteristics. Clear? Now, as you can see that under natural resources, we have kept three things. Number one, raw land. Second is timberland. And third one is farm land. Clear? So we will understand each of them one by one. Clear? So now mark number A, raw land. Make sure that you will put down the notes so that it will be easy for you to remember these concepts. Clear? Now write down, think of it as an empty plot. Think of it as an empty plot. That means on this land, it's completely plain land. Okay, so where you will find it's if I'll tell you, if you'll go outskirts, means if this is a main city, and if you'll go outside of the city, in the outskirts of the city, okay, you will find a huge amount of land which is open with no construction, no crops, no tree, just empty lands. Clear? You can even visit outskirts of Bangalore and Pune, you will find it. Clear? So we call these lands as a raw land. Again, I'm saying no construction, no crops, no trees, just empty land. Clear? Now, point number A. Point number A. Raw land. Now, first bullet. First bullet. Write down. It does not generate income. It does not generate income on its own. It does not generate income on its own unless you lease it out, or sell it at a higher price. So if you want to generate the income from the raw land, two options: either you give it on lease and generate the rental income, or you sell it at a higher price, okay, to generate the capital gain. So these are the two ways you can generate the income out of a raw land. Clear? Now second bullet, its value mainly depends on the location. Its value mainly depend on the location. Clear? Now if that area is going to be developed and you feel like that in the next 5 to 10 years this area is going to be developed, okay, new tech park are going to build nearby, then you will see that the land price will shoot up immediately. Okay, but if you know that in the next 20 years nothing is going to happen in this area, then you will not find any increase in the price of the land. Clear? So it's all dependent upon that how this particular area is going to be developed in the near future. Clear? Point number 3. Big investors or real estate companies, they usually invest in the raw land and wait for the prices to increase. Clear? And when the prices will increase, what they will do? They will build up buildings, societies, and then sell those buildings and societies at a very higher prices. Clear? Imagine people who have bought the land near Navi Mumbai 20 years ago, and now what happened? We all know, everyone means a small 1 BHK will cost you 1 CR. Clear? So this is how you can generate an income. But remember that law and raw land is not easy to sell very quickly. Okay, it's totally illiquid, meaning you have to wait months or sometimes even years, you will find a buyer. So it is illiquid, it's illiquid, or you can say highly illiquid. Highly illiquid, because sometimes we will use this term for bonds as well, but they can liquidate in say 1 day, 2 day, or 5 day maximum. But a land, there is a possibility you will not find a buyer even for years. So highly illiquidity is also possible. But some lands which are in good location, higher demand, they are highly liquid, means even you can sell a plot in my location at 2 a.m. in night. That's the liquidity in my location. Clear? Now, coming to the point number B. Point number B, that is your farmland. Farmland. Now, when I say farmland, think of a Punjab or Madhya Pradesh. Think of Punjab or MP, your Madhya Pradesh. Clear? Now think about the large areas in Punjab and Madhya Pradesh where farmers actually grow the wheat, sugar canes, or soya bean. Clear? That's actually the farmland. Clear? Farmland is different from the raw land because you not only earn from leasing it to a farmer. Clear? But you will also earn from the crops you grow onto it. Clear? Over here we have seen only two ways to generate the income, but in the farmland you can generate the income by growing the crops in the field and then you can sell it. This is known as an operating income. So write down first bullet point. you not only earn from you not only earn from leasing it to a farmer. You not only earn from leasing it to a farmer, but you also earn from the crops. You also earn from the crops grown on it, but you also earn from the crops grown on it. Full stop. Full stop. This is called operating income. This is called operating income. So we can generate multiple incomes if it is a farmland by growing the crops, by renting it out, or by selling it at a higher price. Clear? Second bullet. But remember, crops have to be harvested in a shorter time. Write down, but remember, comma, crops have to be harvested in a short time. Clear? So the timing of price change, so the timing of the price change is tricky, is tricky, is tricky. Price of wheat or rice can change rapidly, means you have grown the wheat. Clear? Now the price of the wheat is say 10 rupees per kg. Might be tomorrow the price is 14 per kg, or day after tomorrow it is 11 per kg, and then 7 per kg. So you can see that price can fluctuate, and it can fluctuate very rapidly. It's totally dependent upon the demand and the supply. Demand and supply. So think it from the investment perspective. If you are investing in a farmland, you think you will generate a operating income, but this operating income is highly volatile, clear? Now in order to manage this risk, you need to take the help of the futures. You need to take the help of the futures. What is your fear? That the price of the wheat will fall down. So what you will do? You will sell the futures on wheat. You will sell futures on wheat. Clear? So if the prices will go down, you are safeguarded, because you have locked your price at which you will sell your crops in future. Are you clear? For example, if I'll give you one a soybean farmer in Madhya Pradesh, they may sell the soybean future on NCDEX. NCDEX. This is an exchange where we trade for the commodity. Clear? So that we can lock the selling price. Clear? Even before harvesting the crop. Clear? Now, most of the farmlands in India as well as in US are still owned by the individuals and families. So there are not big institutions or market players are there, or big companies or corporates are actually into this domain. So who are there? Individuals or families. But now I am writing a new term, REITs. I think most of you are well aware of the term REITs, that is real estate investment trust. Write down real estate, real estate investment trust, real estate investment trust. So now they are coming up so that small investors can also invest in this farmland. Means suppose person like me, okay, I am a employer, or you can say rather than employer, I'm an employee. I'm an employee in Google. Clear? I don't know farming, but I am very obsessed with the income of farmers. I feel like that they're making very good money rather than taking a land and then go there as a farmer and then grow the wheat and then sell in the market. I don't want to do anything. So what I'll do, I'll find a institution. I have given my money to them, and people like me, they have given the money to them. Now they will buy a piece of land. On that land, they will grow and then they will sell. Whatever the profit will come, it will be distributed among each of us. Clear? Are you getting? So in the US also there is a platform called Farmland Partner Incorporation. Farmland Partners Incorporation. It actually allow people to invest in the farmland like buying the shares. Clear? So this is your point number B, which is about the farmland. Clear? Now coming to point number C, that is your timberland. Keep the heading timberland. Timberland. Now when I say timberland, think of the Assam. Think of the Assam. Or you can think of Oregon in USA. It's in India and it's in USA. Clear? Now think of a very large forest in Oregon in US or Assam in India, full of trees, okay, that are grown for the commercial purpose, like teak, okay, pine. That is actually a timberland. That is actually a timberland. Clear? So you are earning the lease income, rental income from that particular land. Clear? And you can also cut the timber and sell it. You are also generating the income from cutting and selling those timbers, just like the farmers are harvesting their crops and selling it. Clear? Now the great thing is that you can choose to when to harvest the tree. Means in the crop you have to harvest your wheat at a given point of time. Clear? But in case of timberland, you have the flexibility when you want to harvest the tree. Clear? Now suppose if this year the price of the wood is low, I won't cut the tree. Clear? You can wait for another year because tree will continue to grow. So this will give you the flexibility. Clear? Unlike the farmland where you have to harvest your crop as soon as they are ready to harvest it. Clear? But in case of timberland, you can postpone it to aim for a higher price. Clear? Are you getting the point? You are getting the flexibility over here. So managing the timberland actually needs special expertise. How to grow, how to cut them, how to sell them, how to replant them. So it's kind of a full-time job. Clear? That's why in the US, okay, I'm specifically talking about the US, the large investors, they go through a professionals called TIMO. 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 Now what this TIMO is? TIMO is Timberland Investment Management Organization. Timberland Investment Management Organization. They manage everything for the investors. They manage everything for the investors. Clear? Now timberland parcels are also huge. Clear? If I'll talk them about the land area, it's huge. It's thousands of acres. So it's not it's usually not affordable for a small investors to go and directly invest in a timberland. It's a very huge. Clear? So multiple investors or big investors come and they play their role in growing the timberland. Are you clear? Now let us revisit this point. First of all, who generates the output? Raw land? No. Farmland, they generate the crops. Timberland generates the timber. Can we lease? Yes. All three are leasable. Easy to sell? No, it's very difficult to sell. And Timberland, though, most difficult to sell. Clear? Who own them? Timberland owned by the institution. Raw lands are also generally owned by the institutions, and farmlands owned by the generally individuals. Output depends upon, in raw land there is no output, farmland there is a crop cycle, and in timberland, timber will keep on growing. You can sell whenever you will get a very good price. Expertise in raw land not required, farmland moderate, but in timberland you require a high expertise. Financing options very limited in each of the three. Clear? Now give a hash and we will understand the ESG angle. ESG, basically helping the environment. Helping the environment. Now, tree, basically the crops and tree, they absorb the carbon dioxide from the atmosphere. So the investors who actually cares about the climate change, they love these assets and it helps them to meet their ESG targets, environmental, social and governance target. Clear? For example, a fund in the UK, they might invest in the timberland in Brazil to help to offset its carbon footprint, and they will also make the money from the timber sale. So both the objectives are met: profits by selling the timber and ESG goals by maintaining the carbon dioxide level in the atmosphere. Clear? So these things are also helping you to fulfill your second objective, which is of the environmental, social and governance. Clear? Now if you want to invest, then how you can invest? Clear? REITs, one option is REITs. Clear? Second, we have ETFs. Third, we have is the LLC or limited partnership, basically in institutional funds. Clear? And the fourth is the commodity futures. Commodity futures, if you just want the complete exposure on the commodity. Clear? So if I want to summarize this first LOS, so raw land, farmland and timberland, they are long term, they are illiquid assets that offers a mix of income. Clear? Whether it is a rental income or price appreciation, or you can also generate the operating income by selling the crops or the timber. Clear? But it comes with their own level of complexity and expertise. So next time when you hear someone they bought a land in Hosur in Tamil Nadu or timberland in British Columbia, you know what kind of investment they are making. Clear? So you got a good understanding about these three types of investments. Clear? Now let us start with the second LOS, your LOSB. Write down: describe the features of commodities. Describe the features of commodities. Describe the features of commodities. Describe the features of commodities and their investment characteristics. And their investment characteristics. Clear? See, basically over here we are going to understand the commodity. See, earlier what we have understood, that we can invest in timberland, farmland, clear, or a raw land. But this time another alternative investment, this is also your natural resources. Okay, commodities, gold, silver, metals. Clear? So over there also we can invest and generate the income. Clear? So we will discuss about that now. Now give the first heading: what is commodity? Okay, think of the things we use daily: wheat, oil, gold, copper. These all are commodities. Now commodities are physical goods, clear, that are same no matter who produce them. Clear? Like one barrel of crude oil from Saudi Arabia is pretty much same as one from the Russia. Clear? Now we divide our commodities into three main broad categories. One is metals. Then we have agriculture. and another one we have is energy. In metals, gold, silver, copper, nickel, lithium, these all comes under the metal. Then we have agriculture, wheat, corn, sugar, cotton, these all comes under the agriculture. Then we have energy, crude oil, natural gas, coal, they all are the part of the energy segment of the commodity. Clear? Now, gold is traded in the Dubai and London market. Clear? From there, we fetch the price, and that price will be traded all over the world. Wheat from the Punjab is priced just like the wheat from the USA. Clear? Crude oil is benchmarked globally using the names like Brent crude. Write down crude oil. They are benchmarked through two different names. One is the Brent crude, it's for UK, and another one is WTI, it's for USA. Are you clear with this? So commodity is divided into three segments: agriculture, energy, and crude oil. Clear? Now, next we have is the commodity contracts. Commodity contracts. Write down commodity contracts. See, when you are buying a wheat, now what you want to specify the price, at what price you will buy the wheat. You also want the quality. Do you want a good grade, average grade, high grade, low protein, high protein? All these needs to be discussed. Apart from this, you also want to specify the delivery location, where you want the delivery, whether you want the delivery in Nagpur or Hyderabad or Chennai. Clear? It's very important to specify all the terms in your contract. Now, when I'm specifying everything, price, quality, location, that will actually impact my cost. That at what cost I'm buying it. Because if it is far away from my location, then definitely the transportation cost will be added. Clear? Might be it's a crop which can which require the huge amount of maintenance, like vegetables. Okay, you have to procure them very safely. Might be you require a proper cold storage for that. Clear? So accordingly, the price of your product will be impacted. So it's very important to specify everything in your contract from the very beginning, because now suppose you feel like that the price of the wheat will increase after 15 days. Currently it is trading at say 30 per kg. Clear? And you feel that after 10 days price will reach 40 per kg. So now you want to buy it, you will buy and store it, so that after 10 days you can sell it in the market. Clear? Now give another hash and write down government role in commodities. Government role in commodities. So we will discuss about three different countries: India, China, and US. So in India, government actually set up your MSP. MSP, that is the maximum support price for wheat and rice, to protect the farmers. What will happen? They want that minimum price is 15 per kg for the wheat a farmer should get. Clear? They can sell at a higher than 15, but not below the 15. This is to protect the farmers. Clear? Similarly, we have in China, okay, the government actually supports the rare earth metal production. Clear? If something which is rare, and the companies are producing it and getting it outside the earth through the mining process, so China government actually supports that. Okay, they provide you the subsidy, they will provide you the required amount of resources, so that you can procure those metals from the earth. Clear? Similarly, in US, the ethanol subsidies actually help the corn producers. Clear? Ethanol subsidies actually help the corn producers. So their purpose is to give the subsidiaries. Clear? Subsidies actually help them to grow more, to produce more. But in India, they are giving a fixed rate that at least you should get this, so that you can produce more and more, and you should make some amount of profits. Clear? Now, climate change policies are shifting many things, like the demand for the lithium, cobalt, and nickel is rising because of their use in the electric vehicles. Demand for the coal and oil may reduce due to the global climate goals, but still we are using. But our aim is to reduce the amount of carbon in the air. So we are shifting towards the EVs or electric stuff or solar energy, wind energy, so that we can reduce the amount of carbon dioxide in the air. Clear? Now, the point is how we can invest in the commodities. Clear? One, we can directly purchase. Clear? But this is not practical for an investors like me. Okay, I cannot buy thousands of bags of rice and store it in at my home or go down, or tanks of oil. It seems not practical. Clear? It is only useful the one those who are trading into it. Means if I tell you about ONGC, yes, they have that storage capacity. They can have huge amount of barrel of oil they can store, but not me. Clear? Then what I can do, if I have to invest in the commodity, I can invest via derivatives like futures, options. Then ETF is also there, mutual funds is also there, separate managed account, SMA is also there. Clear? So when I tell you about a future contract, okay, we know everything. We have studied about the future contract a lot in the derivative, so I'm not digging inside this now. We have done it properly. Clear? Now they are actually traded on exchanges like MCX in India, and CME is an exchange for USA. Clear? Now, since they are exchange traded, you don't have to worry about the counterparty risk. Everything is very safe and protected. You have to put your own margins to enter into these contracts, and if the contract will price will go in your favor, you will make the profit. If it won't go in your favor, you will make the losses. Clear? Then we have the exchange traded products. Clear? ETFs, ETNs. Clear? For example, we have SPDR gold share. Okay, it's an ETF that actually track the gold price. So if you invest your money in the ETF, and ETF is indirectly investing into the gold. Clear? So now if the gold price will go up, the value of your ETF is also going up. It's just like a share price. Clear? So you can buy it directly through your demat account. Even a small investors can invest in. Clear? Then we have managed future funds. Write down managed future funds. These are like the mutual funds for commodity. Some only focuses on the agriculture. Some may diversify into metal, energy, and agriculture. Some are for retail investors, and some are only for the rich or high net worth individuals. So there are many such mutual funds. It's up to you in which you are able to invest based on your pocket or based on your interest. Suppose you want to only invest in the mutual fund, those who are investing in agriculture products, so do it accordingly. Clear? Then we have separately managed accounts. These are basically for the big investors who want to actually customize the strategy, like invest only in the clean energy futures, means solar energy futures. That's what my customization is. Are you clear with this? Now, the next point of discussion is how the commodity prices are actually decided. Clear? Over here comes the future pricing. Clear? Now, future pricing, we know how to calculate it. We know the future pricing. Future price is equals to spot multiply with 1 plus R to the power T. Clear? But this is only the interest cost. We also need to incorporate the storage cost as well. Storage cost, but we also need to reduce the convenience yield, because someone who is holding the gold or holding the copper or holding the nickel, they have the convenience that they have that particular commodity, and it's specifically only for the business owners, the one those who are doing the business in that particular segment. Clear? So we will add the interest cost, we will add the storage cost, which is actually happening to the real investors, and then reducing the convenience yield, which is actually gained by the one who already possess that particular commodity. And we have done this in detail in our derivatives area, so no need to dig inside. But yeah, storage cost is like you pay for the warehouse, insurance, and the risk of any spoilage. Clear? And convenience yield is basically the benefit of physically you have that particular commodity. For example, a bakery in Delhi may want actual wheat in its warehouse during the peak season because the demand is way too high. and they don't want to run out of the stock of the wheat. Clear? Now, two important points: contango and backwardation. Contango and backwardation. Now, what is contango and what is backwardation? Contango is where your future price is greater than the spot price because of the higher storage cost and the interest cost. Backwardation is where spot price is greater than the future price. Why? Because of very high convenience yield. Clear? So oil is often in the contango. Oil is generally, you will find it in the contango because the storage cost is very high. Because the storage cost is very high. Whereas coffee beans, in Brazil, they comes under the backwardation because there is a high demand but low harvesting. So they want it now, not later. So they want to have that convenience of having that particular commodity. Clear? So we have completed the first two LOS of this topic till now successfully and in minute detail. Clear? Now coming to the last and the final LOS of this particular topic, give the heading: analyze sources of risk. LOSC, analyze sources of risk. Analyze sources of risks return and diversification among natural resources investments. The point is, author is saying now you have understood about all the natural resources aspects, whether it is a commodity or whether it is a land or a farmland or whatever it is. Now let us understand which one is best. Clear? So whether it is a commodity, farmland or timberland, we need to understand their risk, the reward and the benefit of them into my portfolio's diversification. Clear? So the point number one, write down: what actually drives the commodity prices? So the answer is supply and demand. Clear? Higher the demand, higher the price. Higher the demand, higher the price. If your supply is more than the demand, then price will come down. Clear? So look at from the demand side, means when you say that the demand is high, when the global economy is booming, factories in China, they need more copper, okay, to build the cars, they need more steel, they need more food, hence the demand across the world will increase and hence the price of the products will start increasing. If there is a recession, demand falls and hence the price will also fall. Clear? Look at from the supply side. Now supply is not always flexible, means you can't just plant more wheat overnight or start a new oil well tomorrow. Clear? These are actually a long term time frame in which you will actually grow the wheat or get more oil. Okay, you need to find more oil fields to get the oil. Clear? So you cannot increase the supply tomorrow morning, it's very difficult. Clear? So if the wheat price will rise in Punjab, farmers cannot double their wheat output immediately. It will take time to prepare the land, plant and grow. Clear? So even if there is small change in demand and supply, it can cause a big price swing, making commodity more volatile. Volatile, circle it, means higher risk. Clear? So the first point is based on the pricing part of the topic. Pricing, because if we are investing into it, it is very volatile. Demand can increase over a small time period, but supply of the commodities you cannot increase in a given small time period. Clear? Now coming to the second point, that is the risk associated with it. First one is your weather risk. Second is your geopolitical risk. geopolitical risk. Third one is your production cost. Production cost. Clear? Now, in Maharashtra, if there is a poor monsoon, leads to the poor sugarcane crop, and hence the sugar price will goes up. In California, wildfires can destroy the timberland, definitely affecting the supply of wood in the market. Clear? Geopolitical risk, if there is a war or political unrest in the Middle East, oil supply may drop suddenly, price will skyrocket. Production cost, if you are extracting the oil from an easy place, then it is going to be very cheap, like Saudi Arabia. But if company have to drill in deep ocean sea like Gulf of Mexico, the cost will increase. Clear? So it's about higher the production cost, higher the price. So whoever will be able to produce a goods or a commodity at a lower cost, they can sell it at a good price to make the profit. Clear? And to beat the competitors as well. Clear? Now the third is from the return perspective. Return perspective. See, when I say the commodity, clear, there is a high potential for high returns, but also it comes with a higher risk. Clear? Are you understanding? It comes with a higher risk as well. If you aim for higher return, you have to go through the higher risk as well. Now, a trade in Singapore who correctly guessed the oil price will rise due to the OPEC cuts can earn a lot very quickly. Means, if I know that price is going to fall, I will go and enter into a sell futures contract because I can guess the oil price is going to rise or oil price is going to fall. Why? Because the OPEC either going to cut the production or increase the production. Clear? And hence the oil price will be affected immediately. So if I can guess it correctly, I can make the profit out of it. Clear? Farmland and timberland. Clear? Basically, they are going to give you some steady returns. Okay, some normalized return, basically normalized return. You won't expect a very high return or a very low return. Clear? And land appreciation as well, but they are less volatile as compared to the commodity. Clear? So an investor who actually own a farmland in Uttar Pradesh can earn a regular rent plus the crop income. Clear? So if you'll ask me on and above, and I'll putting them all into one single portfolio, commodities, if you'll ask the return, very high. Clear? Average return is very high volatility, and correlation with the stocks and the bond is very low. That means good for the diversification. Timberland return is medium to high. Medium to high. If I'll put the bracket like this, low, medium and high. So commodities will lie over here. Timberland will be in between the range. Clear? Farmland will stay at the medium, and stocks and the bonds, it actually varies. Clear? If you'll ask me the volatility, high for the commodity, low for the timberland and the farmland, and stocks and bond, it varies. Some are highly volatile, some are highly safe. Clear? Correlation with the stocks and bonds, all three have a low correlation and good for diversification. Clear? So commodity returns does not move in synchronize with the stocks and bonds. So if you'll add them in a portfolio, it will aim to reduce the risk, and this is known as a diversification. We have studied that portion in the portfolio section. Clear? Now, very important point, that is commodities will act as an inflation hedge for you. Commodities will act as an inflation, means if the price of the goods will go up and hence the price of the commodity is going up, and you hold that commodity, that means what? The value of your asset is also increasing. See, one side inflation is rising, hit on your pocket, but on the other hand, you have those assets, they will also increase in value if there is a inflation. So one side you hurt with the pocket, but other side you are getting good return in your portfolio because commodities will gain value during the recession. Clear? In 2022, after Russia and Ukraine war started, the oil and wheat price shoots up. Clear? So inflation was high globally, but investors who actually have the commodities, they made the good return. Clear? So holding commodities will definitely protect your portfolio during the high inflation period. Clear? So this is what we have studied throughout the topic, and now we know when to add a commodity, a farmland, a timberland to my portfolio, how, what type of return they are going to give to us, risk associated with them, volatile, non-volatile, clear, diversification benefits, clear, risk, whether it is geopolitical, whether it is a production one, whether it is a currency risk, clear, we need to understand each of them. Crude oil, if you'll ask me, investment type crude oil, so risk associated is volatile demand, second is geopolitical risk. Wheat, the most important risk factor is the weather, and second the government policies. Gold, currency risk is there because you are importing it from outside, clear, then you have a storage cost, you have to store the gold safely, clear. Farmland, weather, crop diseases are there, there is a possibility. Timberland, fire risk is there, long harvesting cycle also, clear. Okay, so with this, I am ending this lecture. I have completed it with all the possible examples and everything. So if you want, you can give a thorough reading of the book, but even if you don't give, we have done it properly. Each and every point is covered in detail. Okay, thank you.